Control procedures. This is a very important topic from exam point of view as well as from the position of a professional accountant if you're working in an accounting department. So this is very helpful. We learned the definition of internal control as per the definition given by the IMA. Then we learned the definition given by COSO model, the internal control. IMA says the system of internal control is affected by the management, and it is for the smooth operations of the business. It is for the safeguarding of the assets. It is for following manager policies and to ensure as far as practicable the reliable reporting. Then we learned about the COSO model, that is ERC or ORC, that is operational efficiency and effectiveness, reliable financial reporting and compliance with laws, and it is the same as ERC. Now we are going to study the control itself and a new definition of internal control by the Institute of Internal Auditors. So this IIA basically is the Institute of Internal Auditors. Institute of Internal Auditors, they define control as, I've broken down this definition into its parts. IIA, Institute of Internal Auditors, they say that control is any action taken by the management or board or other parties, I mean within the organization, that will increase the possibility that objectives will be met. Any action taken by management, board and parties that will increase the chance that we will achieve our objective. This definition or this concept is decades old, very old. Now let us see the definition given by the Institute of Internal Auditors for internal control. How do they define the system of internal control? So this definition is included in a book that is collectively written by, this is not in your textbook, this is just an added definition because this will explain you internal control in a much wider way. Three writers, Sawyer, Dittenhofer and Steiner, in their book Internal Auditing, this is studied by the students of CIA, they define controls in this way. They say, it's a long definition, I've broken it down to its components. It says that what is control? Employment of all means, all ways designed or devised to do 5 things. Promote what? Achievement of objectives. Direct our efforts towards achievement of objectives. Restrain activities that might prevent us from achieving our objectives. Govern and check. So all the systems that promote, direct, restrain, govern and check upon our various activities so that we achieve our objectives. The previous definition was the same. Achievement of objective. We want to achieve our goals for the organization, and controls help us achieving our goals. Same definition given by the internal auditing textbook, that internal control helps the organization achieve its objectives. Now, how do we implement control? How do we see control? What are controls? These are controls. Your form of organization, is it a tall organization or a flat organization? Is it managed by the Mudirul Aam or is it managed by the board of directors? Like in Saudi Arabia, there are many musassas, means short establishments, a small size. They are managed by the owner managed business. It has a different organization structure. Some are Shirka Mahduda, limited companies. Some are mid-sized organizations. Some are partnerships, right? So, form of organization is a control. These are all controls. Policies are controls. Your systems, manual or computerized, are controls. Your procedures, how things should be done, who should sign what, who should check what, who should reconcile what. Instructions given by the senior to the subordinates, control. Standards are controls. What you should do, standard costing. Committees made for certain purpose are control. Charts of accounts in your accounting system are control. Your forecast, budgets, schedules, reports, records, checklists, methods, the devices we use, and even internal auditing. This is interesting. Internal auditing is a part of your control system. So these are the maximum, not all. I won't say this list contains everything that is included in control, but instead these are the items that are included in control but are not limited to. Controls can be any other thing not in the list, but you can see control is quite a comprehensive concept. Every big organization A good organization has a very strong system of internal control. I worked so far in 3 companies, and I can tell you that out of those 3 companies, one company was in Saudi Arabia, a very well balanced, a very tightly controlled organization, and it was growing like this. Perfect. Good internal control helps the business to move in the right direction, achieve its goals, grow, make profit. Another company I worked for was in Pakistan, a very tightly managed business, a system of internal control, a system of check and balance, good governance. It was growing this way. And then there was a third company in Pakistan. It had terrible system of internal control. No one knew what they should do. There was no written control procedures. There was no policies properly. Things were not in a formal way. Everyone was doing everything what they could do. And what I saw in that organization, I saw the organization going down just in a period of 2 years. And a point came where they have to lay off 125 people from office. They have to dismiss 125 people because they were not able to pay salary. Why? Control. A good organization has a good system of internal control, a system of check and balance, who should do what, who should review what, who should approve what, should be clearly defined. Successful organizations, I believe, they have a strong system of internal control. Let's see. So, control processes, what they do for us? Control processes are the policies and procedures, standard operating procedures. Like in banks, they have certain rules to follow. When they clear the check, when they clear an LC, when they open an LC, when they grant a loan, they have a written policy to follow. They have a written procedure to follow. So what are control processes? Control processes include established standards, how the work should be done. Then our workers will work. We will then compare their actual performance with the standard. That this is what they should have done and this is what they have actually done, standard versus actual, and then we will see what are the deviations. There will be some deviations, there will be some anomalies. We should rectify them, we should correct them. Right? So one important thing is that we set standards, we compare the actual performance with the standard, there are deviations, and then we take some corrective actions for those deviations. Okay, good. We set these standards, let's say in 2010. Now it is 2024 or 2023 end. 14 years are gone. Are these standards relevant? No, they are very old. We may revise, reappraise our standards as the time passes. We revise them so that they become more relevant. This is an important point. Standards once set, they are not forever. You need to revise them, keeping in mind that there are changing circumstances. Right? So there's some important point to note that when we set a system of internal control, who should do what? We make certain policies, we make certain procedures. We should link our reward system and evaluation system with how people are supposed to work and how they actually work. Those who work well, those who follow the control system, those who comply and follow the instructions given by the policies, procedures, they should be rewarded, promoted, given salary increments, so that people are encouraged to follow the new system, to follow the established policies and procedures. Right? This is important because we want people to follow our standards, so for that we need to encourage them. Now, every internal control, every procedure or policy we set, it has a certain cost and it has a certain benefit. We will adopt only those controls for which cost is less than benefit. Like we have a system of control for inventory calculation at the end of every week, and it cost us maybe $3,000 cost of this reconciliation and this calculation. Let's say $3,000, but the benefit is, let's say, of $50,000 because we save this money by by checking things on time, and there is no stock lost, stock stolen. So cost must be less than the benefit. Only then our system of internal control will be effective, will be efficient. Cost of control must not be greater than benefit, rather it should be less than benefit. Right. Now let us discuss some categories of control. There are primary versus secondary control. We'll discuss this all in the next slides. Then there are time-based control, there are financial versus operating control, and then people versus system-based controls. So control, we know these are policies and procedures, budgets, manuals, this, that. Let us see now them from a new categorization. Let us first see the primary versus secondary control. Primary control are of 4 types. Let me first show you what 4 types, and then we'll discuss them one by one. Primary controls are preventive control, then they are detective control, second category, then they are corrective, and the 4th category are directive controls. So primary control, which is the first categorization right here, there are 2 types. 4 types. Primary controls are of 4 types, and then secondary controls are of 2 types. We'll discuss these first and then we'll move on. So let us first discuss 4 types of primary control and then 2 secondary controls. First primary control is the preventive control. Means we should prevent mistakes and errors and frauds from occurring. We should prevent, we should deter unwanted events from occurrence. How can we do that? Like for example, keep your cash in a locked safe. It's a good preventive control. No chori, no theft. Segregation of duties. We distribute our duties that A should deposit the cash, B should record the cash, C should authorize, D should reconcile. This is called segregation. It's a good system of primary control called preventive control. Segregate duties. Keep duties to different people. Then again example that designing database in our system such a way that a letter in the field that stores social security number is not allowed. Like for example, we have a field in our database that can only store numbers 1, 3, 7, 4, only numbers. This field should not allow any letter like ABC. This is a good preventive control. If someone by mistakes put ABC, system will not accept. Only numbers. This is a good preventive control. If you ask me, what is the best control of all controls? The best control is the preventive control. This is the best control. If you give me $100, sir, I have $100, you can spend it on setting a system of internal control. I will spend $99 on preventive controls and $1 on other controls, that is the detective control, corrective controls, directive controls. I will spend $99 on preventive control. This is the best control. Best control, the most effective control is the preventive control. Do not let mistakes happen. Keep check and balance. Segregation of duties. He should do that. He should do that. So this is the best control to prevent against fraud and error. But it doesn't mean that preventive control are always good. We should have some detective control. So preventive controls are the most effective, most efficient. Why? Because they will prevent any unwanted event from occurring. Then we should have another control, also called the primary control, is the detective control. That if some error has occurred, we should catch that error before it is too late. Like for example, bank reconciliation statement. This is a detective control. If something has happened, it will alert the people that something bad has happened. Right? And it is effective when detection occurs before a material harm occurs. They are good controls because they will identify or alert the management that something is going wrong. So detective controls are good controls to identify if some event has happened. First, we should not allow any bad event from occurring, but if some event has occurred, we should have a control that should detect it. That should detect it from occurring. Like for example, a system should not allow the processing of batch invoices unless it is approved by the manager. Our system should not allow a double payment to a single vendor, like we purchase goods from vendor A for $10,000, system should not allow more than two payments or more than one payment of the same amount for same invoice. It should be rejected by the system. It's a detective control. It will detect the mistakes, right? Similarly, there's another example. A detective control provides automatic reporting of all rejected batch to the accounts payable department. All the mistakes identified are reported to the accounts payable or whoever is responsible. So detective control, they will detect something that has gone wrong. This is the second preventive control. Then the third preventive control are the corrective control. Now we were unable to prevent, we were able to detect. Now the time has come that if any error has happened, we should correct it. Corrective controls, they will rectify things that have gone wrong. So corrective controls, they will correct the negative effect of unwanted event. Like for example, you calculate variance analysis. Variance analysis is a detective control. When you calculate variances, it's a detective control. And then those variances must be corrected. What went wrong? We should find the problem and we should correct it. So corrective controls correct the negative effect of unwanted events. This is the right answer. Cost variances over a certain amount must be justified so that these mistakes or these wastages do not occur. Then the fourth primary control is called the directive control. Directive control, they tell people what to do. They guide people what to do. They encourage people what to do. So what they are basically, they are your policies, written policies, tell people what to do. Procedures, they tell people what to do. Employees training, they tell people what to do. And job description, they tell people what to do. Directive controls are the guidances, are the instructions to the workers what they should do. So these four are called primary controls. Now, the next two controls are secondary controls. Primary versus secondary. There were 4 primary and now 2 secondary. Secondary controls are the controls, sometimes they are called compensatory or mitigative controls. The typical example I give, what I experienced in Saudi Arabia, that in many small musassas or establishment, there are only 2 people working. One is the accounting manager, Mudirul Mal, and then there is another assistant following his manager. Just 2 people, account manager and his assistant. Now, when there are only 2 people in the accounting department, we cannot implement segregation of duties. That A should deposit cash, B should record, C should reconcile, D should authorize. It is not possible, only 2 people. So when this is the situation, when primary controls are ineffective, or maybe when we do not have the resources to hire these many people in the accounting department, then there are certain controls that we can use to mitigate the overall risk. What we can do, like for example, the assistant holds cash, he prepares cash book, he deposits cash in the bank, and he is the one who reconciles all 4 things he is doing, which should not be done by one person. So what we should do, we don't have people. So this accounting manager should review the BRS very closely. And then the person on top of him, maybe Mudirul Am, the general manager, the owner of the Musassa, the establishment, he can check BRS himself. So there are 2 checks, one by the accounts manager himself and then by the Mudirul Am. So there are 2 checks. So these are called compensatory or mitigative controls because we cannot implement full system of control. So someone else should take the charge and make the shortfall in the problem. Like account manager and Mudirul Am, they are checking the BRS, checking the petty cash vouchers, all faturas are in place. So this is the way we can do it. Even we cannot implement segregation because we have few people. So such controls are called compensatory or mitigative controls because our primary controls are ineffective because of small organization. So these controls can at least sometimes help. Second type of secondary control is the complementary control. Let me explain with the example. Let's say we have a person A who is responsible for cash recording, person B who is responsible for cash deposit, and person C who is responsible for cash custody. He holds cash. Now we send person B to the bank for deposit. He takes 10,000 Riyal and deposits it in the bank, and bank gives him a deposit slip, signed and stamped. Now, we already have segregation of duty in place, great. And this deposit by B to the bank through a deposit slip, and this deposit slip is signed and stamped by the teller, validating that the amount has been deposited. This deposit slip is a proof money has gone. So this very good primary control of segregation of duties, it is complemented or made even stronger by this deposit slip. That there is a good system of internal control in place, segregation duties, and this deposit slip has further improved, further strengthened the system of internal control, right? So this is the idea in complementary control. They work with other controls to reduce risk. They work with other control like segregation of duties plus deposit slip validated by the bank. So these, when the controls work together to make system of internal control even stronger, this kind of control is called complementary control. Then the next classification are time-based controls. There were 4 classifications. Remember, let me show you. We were doing 4 classification of controls. This we done. 4 types of primary control, 2 secondary control. Now we will do time-based controls, financial versus operating, and people-based and system-based controls. So moving on to the time-based control. Time-based controls I can explain with an example. There are 3 types of time-based controls. One is called the feedback control. Let's say a worker A is working. He produces 100 units and then his supervisor checks the quality of those 100 units produced. After those units have been completed, only then he is checking. Such a control is called feedback. After the work has been done, you are checking all the items produced. It is called feedback. Something has already happened. Okay. What about concurrent control? Concurrent controls mean the worker is producing units and supervisor is watching him work, guiding him side by side as he is producing. Right? Such a control is called concurrent control. The work is being done and it is supervised at the same time. Same time. They are doing things together. Such a control is called concurrent control. And what about the feed forward control? We tell our worker, listen, yahi, do this, and this, halas. Follow the instructions. So, feed forward controls like policies and procedures tell the workers what they should do and they should do work accordingly. So, this is called the feed forward control. So, feedback after the work is done, concurrent control when the work is being done, at the same time you are guiding, and feed forward are instructions and policies that the workers should follow. These are the 3 types of time-based control. Next type of controls we have are called financial versus operating control. As the word tells us, financial controls are the controls that are based upon accounting principles. These are the controls based upon the accounting principles. Right? Means in accounting principle, what we know is that someone should authorize a transaction, A. Someone should keep a record keeping, B. Someone should safeguard the assets, and someone are responsible for compliance with the laws, regulations, and contracts. These are your financial controls. Means transactions are properly authorized, record keeping is appropriate, assets are protected, and we follow the laws and regulations. This is the definition of internal control we read a little while ago. So that internal control is specifically for financial reporting. Now what about the operating controls? This is not our work. This is not the work of Mudirul Mali. We financial managers or the accounting managers or supervisor. Our role is this. This is our role. But this operating control, this is the job of Mudirul Am or the other operational management, maybe the warehouse manager or maybe the sales manager or the purchasing manager. So operating controls, they apply to production and support. We are not in production. We are not in sales. We are not in warehousing. Our job is here. So what about the operating controls? Operating controls are based upon the management principles and methods, how the business is managed. We don't manage business. We manage accounting information. We manage accounting records. Right? Management of the business. This is the job of the Mudirul Am and the other production and support activities. Right? Who should plan production? Who should organize, direct, and controlling? This is not our job. These are the controls related to operations. related to the operational activities. Such controls are not the subject of our studies as management accountants. This is the role of the operational management. The fourth classification are the people-based control versus system-based control. As the name suggests, people-based controls are those controls that require human involvement, intervention by people. Right? For example, bank reconciliation statement, it is prepared by people, human beings. XYZ, Ahmed, Basel, these are the people who prepare reconciliation. People, human beings. Like preparing checklists at the end of the month, we do, human beings. So these are the controls that are they are carried out by people, human beings. But there are certain controls which are inside a system called the system-based controls. These controls, they require no human involvement. Like for example, our system has a control that any check above $100 million or 100 million SAR, it must be approved by the general manager. Any check above $10 million or 10 million Saudi Arabian Riyal. So this, otherwise, system will not process the payment. Or let's say to bring it more relevant, any purchase order exceeding 500,000 Saudi Arabian Riyal, any purchase order will not be processed by the system unless it is approved by the general manager. See? So such a control is implemented by the system. System will not let the transaction process unless certain criteria is met, certain conditions are met. So system-based controls, they require no human intervention. Like I go with the example, purchase order above 500,000 limit submitted to the vendor without managerial approval. That purchase order will not be approved by the system. So these are the system-based controls. Now let us study the use of control matrix. Let me first show you what is the control matrix. This is the control matrix. This tells us that we have different risks, risk 1, 2, 3, 4, 5, 6. For managing each risk, we should have a certain control. This is misconception that risk 1 is managed by control A only, risk 2 will be managed by control B. It doesn't mean that for every risk we have a single control. No. It is possible that a single control can manage 2 risks, and it is possible that one risk is managed by 2 controls. So it is not always one-on-one. See, one control can manage 2 risks, and sometimes a single risk requires 2 controls. This layout, this arrangement of controls and risks, this is called control matrix. So that's the idea we should understand well. So controls do not necessarily match risk one-on-one. For every control we should have a risk. For every risk we should have a control, not necessarily. A single control can address more than one risk. Yes, look at this. This single control A can manage 2 risks simultaneously. Like for example, preparing a bank reconciliation statement. It manages 2 risks same time. That our cash book and bank they tally, and that there is no unauthorized cash embezzlement. See, 2 risks are being managed by a single control. And similarly, one risk which is so big, it requires 2 controls, this and this. That's the next step. It says, and more than one control may be needed to adequately address a single risk. Maybe sometime a risk is so big, it requires more than one control. Like for example, our inventory is properly valued. It's a risk that maybe inventory is overstated or understated. So there are 2 controls for it. One, we make weekly reconciliation of records and inventory, and at the end of every quarter, there is a physical stock taking by the internal auditor. So we 2 controls are managing a single risk, right? So that's the idea. All right. So this arrangement where we plot risk and control side by side, this is called the control risk, matrix. We just learned the idea. Just like the example here. For example, all petty cash custodian must deposit vouchers periodically. Now this control itself is managing 2 risks simultaneously. What risk? Petty cash accounts are maintained at the established level. This risk is being managed, and petty cash expenditures must be reviewed for appropriateness. See, two risks are being managed by a single control. And this is quite a nice way to match risk and controls. Now, again, coming back to the topic of internal controls, a good system of internal control, if designed well, it should reduce risks. If a system of internal control is designed, who should do what, it is clearly defined responsibilities, it will reduce the risk of errors, it will reduce the risk of fraud. Our objective is that we should not allow unlimited power to a single person. We should delegate works to ABC in such a way that an individual, a single person, cannot perpetrate and conceal a fraud. We divide responsibilities in such a way that if a person commits a fraud, someone catches him. Like, for example, our person responsible for depositing cash, he puts 10,000 Riyal check in his pocket. He cashes it and puts it in his pocket. He thinks he will not be caught. We have a system of BRS every week. When we prepare BRS, we will see that his 10,000 has been deducted from the bank. Where is the money? Who was responsible for? This person. Okay, catch him. Right? So a good system of internal control, it should not allow a person to commit a fraud and hide it. When we divide the responsibility in three: authorization, record keeping, and the custody into three different individuals. You should add also one more. I always recommend students to memorize this CAR. Custody is given to a separate person, custody of cash. Authorization for cash transaction is given to a separate person. Record keeping of the cash is given to a separate person, and reconciliation is done by a separate person. This way, a single person cannot commit a fraud and he cannot hide it because someone else will check. See, this is a very important idea in the internal control, that segregation of duties must be in place. Three functions should be performed by separate individuals. I would say 4 functions: custody, authorization, record keeping, and reconciliation. He says that authorization, record keeping, and custody, add reconciliation also. These 4 functions should be performed by separate individuals. This is a very good control, and unfortunately in small organizations we cannot have these many people. So for those, we have some compensatory controls, some review by the Mudirul Am, by the Mudirul Mali, so they keep a very close watch. They listen to their phone calls, they keep on watching through cameras, and they keep on watching what the activities they do. But unfortunately, the control is weak, so we should have some other check and balance to keep a watch on our employees. Then, independent checks and verification. Now, let's say we have given 20,000 Saudi Arabian Riyal to our petty cashier. He spends money from this. We want to make sure that he doesn't spend the money for his personal expenses. For eating kapsas and Pepsi, we should check the cash balance with him. Suddenly and surprise check must be conducted by internal auditor and ask him, okay, give me the cash. How much cash do we have? Okay. Compare this cash with the invoices he has and then reconcile. If there is unexplained cash shortage, he should explain. Where is the money? This is called independent checks. Verifications. Okay, we have asset A, B, and C. All right, let's check with these assets where they are. Okay, we have asset A, fine. We have asset B. Where is asset C? Who is responsible? X. Ask S. Where is that asset? So this is independent checks and verifications are very important controls to ensure that things are in the right direction. They are going okay. Safeguarding controls. These are the controls to protect our assets. Just like I told, verification, verify the assets records and their existence. To protect. Safeguarding means protecting. Then I'm sure many people would have seen pre-numbered forms. Some forms, when they are printed by the publisher, they carry a certain number printed on it, like A1000, A1001. It is already printed on the stationery printed by the publisher, and then it runs through the computer system, and then computer adds a certain computer generated number. Let's say this is an invoice. This number, which is already pre-printed, pre-numbered on the stationery of the invoice, this is a very good control, because if we have issued 100 invoices during the period, and those 100 invoices, if they are arranged in sequence, they should be one A100 and they end up at A1099. Right? It means all the 100 invoices are accounted for. If there is any invoice missing, you should investigate what happened. Okay, we investigated the invoice A1078. This number is missing. What happened? When we checked, we identified that this invoice was stuck in the printer and the page was torn. So we have just taken the torn one, taped it, correct, and then put it in the file. Same like checkbook. Every checkbook has a sequential check numbers. They are in a certain sequence. If any sequence is broken, you should ask. Same goes for receipt book. Receipt book, which we use to collect check from our customers, those receipt books have a certain number. Those numbers must be in sequence. This pre-numbered form is a very good control to control the documents. Any sequence, any number missing is a question mark. Where is that? Then in every organization there is a specific document flow. Like for example, when we want to request a material, our inventory control department, it will request the material called the material requisition form. This material requisition form generated by inventory control goes to the purchasing department. Purchasing department then, based upon this material requisition form, will raise a purchase order. This purchase order, if a large amount is involved, then it must be approved by the general manager. Then this purchase order, after the approval, goes to the vendor. And then vendor will send the goods and invoice. So there is a specific flow of documents who should perform what. We will see it in our control cycles. Then this is an important concept, tracing and vouching. How it works, let me show you. Let's say you have an electricity bill of 118,000 Saudi Arabian Riyal. This was the electricity bill paid for the month of April 2023, for example. Okay. If this is the electricity bill paid, is it paid stamped by the bank? Yes. Let us trace this electricity bill into the ledger. We should find this amount in the electricity bill expense for April 2023. So taking the source document and moving it forward and seeing how it is reflecting in our records. This bill we found is there in the electricity bill expense. It means kullu miya fi miya. The invoice, the fatura for electricity bill has been accounted for well. Agreed. Tracing. This is called tracing. What is vouching? Vouching involves when we see our non-current assets, we find that there is a computer which we bought for 1500 Saudi Arabian Riyal. It is shown on our asset register. Okay. When did we buy it? Where is the original source document? We will take this amount and go back to our original records, and we will find that this computer was bought on this date from this individual, from this company. So tracing means taking the original source document and finding it in the records, and vouching means taking a number from the records or from the balance sheet or the ledgers and going back to the original document. These ways we can move both ways to identify if there is something wrong in record keeping or maybe with the invoice. Okay, now let us see the organizational structure of some large or mid-sized organization and see how the segregation of duties should be in place. This is not how every organization is arranged. Like I was working in a firm in Saudi Arabia where the CFO and the chief accounting officer was one person. But our good system of internal controls tells us that chief accounting officer is responsible for record keeping and chief financial officer responsible for credit, cash disbursement and cash receipts. So you may find that these hierarchies, these segregation given here may be different from the business you are working in, but this is how it should be. This is the idea. This is the standard used in the world, in Europe and in the US. Now, what the arrangement is: corporate level executives, vice president of operations, or maybe the manager of operations or the director of operations. This person, director of operations involves sales, warehousing, receiving, shipping, production and purchasing, all involving your business operations. This is a separate domain headed by the Director Operation, VP Operation, or the Manager Operation. Then we have Chief Accounting Officer, also called the Controller or the Accounts Manager sometimes. He is responsible for record keeping, account receivables, record keeping, billing, record keeping, accounts payable, record, general ledger, record, inventory control, record of inventory, cost accounting, record of goods produced, payroll, record of salaries to our staff. The Chief Financial Officer, responsible for cash receipts and cash disbursements, cash in and out, and the credit, approval of credit to our different customers with the credit limits. Agree. Vice President of Administration, Manager Administration, Director Administration. He has many roles, meetings, arrangements of cleaning stuff and upkeeping the buildings, and out of many roles, he is responsible for mail room. Only this is relevant for our accounting cycles. Administration is quite a wide thing. Maintaining of the assets, authorization and approval of the goods, material leaving from head office and coming in. Many things administration do. One of these is mail room. Then Vice President of Human Resources or Director Human Resources or Manager Human Resources, responsible for human resources, the people working in the organization. So this is how the things should be. We have 5 accounting cycles which we'll discuss in details. And these 5 accounting cycles involve: first cycle, we sell to the customer on credit, and on this credit sale results in account receivable. Second, those customers pay us and we book this cash in our accounting records. Then the third part, we buy goods on credit and this credit purchase results in accounts payable. Okay, and when these accounts payable are due, we make cash payment to satisfy the accounts payable. And finally, the 5th cycle is our employees' work on the production. How do we allocate the cost on production? This relates to payroll. So these are the 5 accounting cycles which we are going to discuss in our coming slides. Now, there are some instructions that we should follow. First, the documents that originate outside the organizations are separated by thick border. Let me show you what it means. Look at this. This customer order, it is generated outside the business because customer who buy goods from us is outside. So he generates this customer order and this is separated by a thick line. This thick line is a boundary representing that this is our business and this is outside world. Same goes for the next. Look at this. This thick boundary indicates our organizational boundary. Customer is outside. Bank is outside. So this thick boundary indicates that this is the limit of the organization. So this is the first line here given, that the documents generated outside the organization, they are separated by thick borders. Okay. You should not memorize these accounting cycles. It's just for the understanding how things should be. Our focus is to understand them. And then we will be able to relate these cycles to the organization we work for. Right? Good thing is that if these cycles are understood well, if you understand these cycles, there are 2 benefits. First, you will be able to answer questions on CMA exam, and second advantage is that these cycles will help you understand how things should be done in your organization. This is the standard approach followed in large to mid-sized organizations around the world, especially in the US and Canada. And again, a good important point to note is that not all questions of CMA exams will follow the exact cycles. It's just for our understanding that this is how things should be. So let us first start with the first accounting cycle, that is the sales receivable cycle. That we sell goods on credit and it results in an accounts receivable. Now, as I said that we will have ARC, someone will have authorization, someone will have record keeping, someone will have custody. Let us see who are the people responsible for authorization. Customer authorizes issuance of purchase order, customer order. Sales authorizes the sales order to be generated. Credit department authorizes the sale to the customer, and billing authorizes the issuance of invoice. All these have authorizations within our organization. And the customer is of course outside. Custody. Who holds the custody of goods? Warehouse has the physical custody, and shipping, they will take the goods to the customer. Both have the custody and they have no record keeping. These people have authorization, no custody and record keeping. These people have custody, no record keeping, no authorization, and record keeping is maintained by inventory. Inventory control contains the records of inventory. Warehouse control contains the physical goods. Account receivables maintains the records of customers, and journal ledger, you know, it's the mother of all books that contains all the accounts in our business. So these are the individual parties and the authorizations, custody and reconciliation. Now let us start how it works. Okay, now let us understand the sales cycles in a detailed way. Let's see how things start. Our customer, they start the process. This is called the horizontal flow chart, or sometimes called the system flow chart. Our customer will issue a purchase order which we call the customer order. This customer order is initially received by the sales department. Sales department cannot allow the sales unless this order is first sent to the treasurer, the credit department. They will check the credit limit of the customer. Is the account balance okay? There is no over limit? No. Is the amount within the credit limit? Yes. Okay. Done. The sale order is now approved. The sale order is now approved. There will be multiple copies of sale order. One copy goes to the inventory control, those who maintain the records of the inventory. One goes to the billing, that will generate the invoice. One goes to the shipping, that is responsible for the delivery to the customer. One copy goes to the warehouse. They are responsible for taking goods from the warehouse for delivery. And then this one copy goes to the sales department, who will acknowledge and give it to the customer. Okay, your order is approved. Wait for a week, we will deliver the goods. Okay, what happens then? First action will be taken by the warehouse. Warehouse receives the approved sale order. They will take the goods from the warehouse, and then they will prepare the packing slip. Packing slip is a document that contains what items and in what arrangement have them been packed. Packing slip is created. These goods taken from the warehouse are transferred to the shipping department, who will ship it to the customer. Packing slip has multiple copies. One copy goes to the billing department, one goes to the inventory control. I will explain what they will do with it. So this packing slip with the goods, they are given to the shipping department. Shipping department will prepare a bundle of the goods. They will either ship it themselves if they have their own trawlers, or the shipping department will forward it to the logistics company like Aramex in DHL or UPS. They will give the goods to the shipping company, to the logistics company, and they will give you the airway bill or maybe the bill of lading indicating that these goods are now being received for the onward customer delivery. So the shipping will then forward the goods, and these goods together with the goods, packing slips and bill of lading are delivered to the customer. Customer will match that whatever was ordered is received. Yes. Okay. Now let's see what happens next. Billing department, since he received the bill of lading, means goods have been delivered, the billing department will raise an invoice. One copy of invoice goes to the account receivable so that the account receivable file is updated. One copy of the invoice goes to the journal ledger for daily summary of invoice, and the original invoice goes to the sales department, who will forward this invoice to the customer. Now customer has three things to compare: what customer ordered, what customers actually received, and what is the invoice all about. If they are all okay, the customer says, okay, kullu miya fi miya, I ordered ABC, I received ABC, and invoice is also for ABC. Perfect. And sales department will keep one copy of the invoice in the sales order file. Inventory control will update their inventory records. Now there are two reconciliations we should make. This journal ledger, it contains an account called the account receivable control account. Account receivable control account, in which all the monthly invoices, all the monthly collections are posted. The balance shown by the account receivable control account should reconcile with the total of the customer A, B, C, D, E, F, G. If my account receivable control account is showing $100, let's say, my individual customers sum A, B, C, D, E all must be equal to 100. Means the balance shown on the account receivable control account must be the same as the balance shown, sum of the balances on the individual customer accounts. Added, they should be the same. This means that our individual customer accounts and our general ledger account receivable control account, kullu fine. Reconciliation done. Then second reconciliation is that our inventory records show inventory of $157,000. What about the inventory records? Inventory records also show $157,000. If there is any difference, that needs to be investigated. So these two reconciliations. So you can see that authorization, record keeping, reconciliation, they are kept separated. And this way, things move nicely. So this was your sales receivable cycle. Now once the sale has been made, the customer will pay. Let's see what is involved in the payment process. Here we go. Again, authorization, custody and record keeping has been separated. Customer authorizes the issuance of check. Okay, we will see. Bank will authorize the validation of deposit slip. We will see. Custody of the check will be with the mail room once the check are received from the customer, and custody of check is with the cash receipt, that is the treasurer. Record keeping, when the amount is received from the customers, it's with the account receivable department, and record keeping is also with the general ledger. Right? So these are ARCs. Let us see in detail how the process is taken and how things move. It starts from the customer. Customer will send a check and also attach a remittance advice that this check I am paying. It is for $100,000 and this is for invoice A, B, C, D. Kullu total this. So this check and remittance advice, they are into an envelope, and this envelope comes in mail or maybe in PO box. In Saudi Arabia we get mail through post office box number. So whatever, directly through Aramex or maybe in our mailbox, we receive all the envelopes. Envelopes come in the mail room. There will be two persons, not a single. This is an important point. In mail room, there must be two persons, person A and person B, or maybe more than that. So that a single person, if he receives check and if he sees any open check, he can put the check in his pocket. We should not let that happen. There must be two people, one watch over the other. These people in the mail room, they will open all the envelopes, they will separate the checks, and they will separate the remittance advices. Every check and remittance advice is separated. They collect all the checks and make a remittance listing. Remittance listing means we write that we received check for this amount from this customer at this bank, this amount from this customer drawn on this bank. So this remittance listing is given to the cash receipts so that this could be recorded in the cash receipt journal. Okay. Checks are given to the treasurer also for deposit slip. Checks are delivered to treasurer. Treasurer will draw the deposit slip of all these checks. And these checks with the deposit slips, they go to the bank for deposit. Banker will take the checks and stamp the deposit slips. These validated deposit slips will come back to the treasurer, indicating that those checks sent, they have all been deposited, and this will result in updation of the cash receipt journal. Alright, then what about the remittance advice? These remittance advices, together with the copy of remittance listing, it goes to the account receivable. See, account receivable, they receive no cash, no check. They only receive the remittance advice. Account receivable based upon the remittance advice will update the account receivable, individual account receivables based upon what amount is received from each customer. Okay. And then this remittance listing for the whole month or for the whole week, it is used to update your general ledger. And when we say general ledger, that means you're talking about the account receivable control account. Right? Now, there are two reconciliations we should make. First, the collections made from customers were, let's say, $170,000. Okay? And after these customers' collections, this is the balance in our account receivable control account. Does this tally with the sum of the account receivables in individual customers account, also called the subsidiary ledger? If the balance shown here is, let's say, $195,000, the balance of or addition of all the customers should also give 195. Okay, some customers can have a credit balance if they have overpaid. Most of the customers will have a debit balance, but the net of these should be equal to this. This means that the account receivable individual are tally with the account receivable control account, so mean account receivable kulumia FMA. We should then generate account statements for customer A, B, C, and we should send the account note statement to our customers so they can verify. So for this particular check, we sent the account statement directly to the customer. Account receivable will send the statement to the customer. Second reconciliation we should make is that we collected a certain amount of money, let's say $170,000, and this has gone to the customer's individual credit accounts. This should tally to the total amounts received from the customer, which means all the collections made have been accounted for in the individual customer account. This way we are managing our AR nicely and things are okay, no problem identified. Next cycle involves purchase payable cycle. Purchase payable cycle means we buy goods on credit. It results in accounts payable and we need to book accounts payable accordingly. So there are certain authorizations, custody and record keeping. Let's see how they are involved. Inventory control, they will request that there is a material shortage. They will give what you call the purchase requisition, or sometimes called the material requisition form. Whatever the name we call it, basically it's the purchase requisition. We need these materials because inventory control have the records of inventory, and when they see the inventory is below a certain limit, they will request the material. This is called the purchase requisition. Purchasing department, they will issue purchase order. Inventory control, they will issue purchase requisition. This is the authorization. Custody of goods. Goods are originally held by the vendor. When he delivers the goods are received by our receiving department, where they will count it, and after the counting, producing the good receiving note, they will forward it to the warehouse where the goods will be stored. There must be a very clear understanding. Warehouse control has the actual custody of goods, whereas the inventory control, this department has the records of goods. Records of goods or material. This is important. Warehouse has the goods, physical custody. Inventory control has the records of goods. They are separate departments. And then a recording is maintained by accounts payable for the suppliers and general ledger for the accounts payable control account. Now let's see how things actually take place, or how things should take place. It starts as per the system flow chart. It starts from the inventory control who works under the controller. Remember, controller has all the record keeping with him. Let me show you. Controller has all the record keeping: account receivable, billing, payable, inventory control, cost accounting and payroll. See, inventory control, record keeping, right? And warehouse control, where the actual physical goods are, it is under the operations. They are two separate departments. The unfortunate thing is that what you will see in your organization is that inventory control and the warehouse control, they are the same department. Means the warehouse, they have the physical custody of the goods, and they are the same people who have the records of the goods. This is not the right thing. Inventory control, record of the inventory must be separate and goods must be separate. Those who have goods, they should have no access to records. But in many organizations, you will see that these two departments are run by the same person, which is technically not right. So the purchase requisition is raised, mean that when it will be raised, let me give you the idea how it works. Let's say we have certain item A, and whenever it falls below 100 units, the inventory control department will see that the quantity has fallen to 93. They will request more units of it. So inventory control, they will generate a purchase requisition requesting item A to be bought. So the requisition, called the purchase requisition, it will have two copies, one sent to the purchasing department and other sent to the accounts payable department. Why accounts payable? Because they will later match when the goods are actually received. So the copy of the purchase requisition that goes to the purchasing department, when they receive the purchase requisition, they will generate the purchase order. This purchase order will have multiple copies. One copy goes to the accounts payable department and one copy goes to the receiving department who will receive the goods, and the original purchase order is delivered to the vendor who will deliver the goods. Now there is a very fine point which is basically not covered in your textbook or maybe in the questions. The copy of the purchase order sent to the receiving department, it has only listed items. We requested item A, B or C. There is no mentioning of price, no price. There is no mentioning of quantity. Only that it will tell that we requested A, B and C. No mention of price, no quantity. Now the thing is, receiving department has nothing to do with price. Makes sense. We have no price. But why did you cross the quantity? Why did you not tell them how many A's we requested, how many B's we requested, how many C's we requested? It is because when the goods are actually received, they will physically count the goods and put the number themselves. If we already tell them how many A's we requested, how many B's we requested, how many C we requested, they may not count it properly, or maybe they will put the extra item in their pocket. Do not tell them how many units we actually requested. Keep the price and quantities crossed. And when they receive the goods, they should themselves count and then put it in the records. Right? So this is a very important point related to the receiving department. So purchase order received by receiving department, it only mentions item requested. No price, no quantity. Okay. So this purchase order, when it goes to the vendor will, as per the request, send the goods and packing slip directly to the receiving department. Now receiving department, they have a copy of the purchase order with them. So what they will do, based upon what was requested, they will write a receiving report. They will see item A collected how many units, 100. Item B collected how many, 90. Item C collected how many, 80. This is called the receiving report, sometimes called the good received note, GRN. This receiving report will have multiple copies. One copy goes to the warehouse, one copy goes to the inventory control, and one copy goes to the accounts payable. Okay. Now what happens? The warehouse department, they receive the goods and they receive the receiving report, and they will match ABC mentioned in the receiving report and ABC received in actual. The quantities must tally. Match okay. Kulumia fimia. Goods are there as per the receiving report. Inventory control, when they receive receiving report, ABC, these many units, they will update their inventory record, but before that they will match with the packing slip. ABC ordered versus ABC actually received. So when all is found okay, they will update their inventory records. So remember, inventory control has the records of inventory and warehouse control has the physical custody of inventory. Okay. One copy of receiving report goes to the accounts payable. Now this is a very important part. Receiving report, purchase order and purchase requisition. The accounts payable department, they will see that we requested ABC. How many A's? 100. How many B's? 90. How many C's? 80. Okay, this was the requisition. What was the purchase order? Purchase order had the same quantity. Okay. And how many ABCs received? Same. A 100, B 90 and C 80. It means kulumi fimi. All the items originally requested are originally purchased and same have been received. Good. Now we should debit the purchase and credit the accounts payable. Account payable has been updated. All done. Now there are certain reconciliations. All the purchase order for the month or for the week, they will update your general ledgers. That means your accounts payable control account. Here you will have the individual suppliers account, supplier A, B, C, D. Now your accounts payable control account shows a credit balance of $190,000. And your individual supplier account, their total also shows 190. It means that the accounts payable control account and the individual sum of the suppliers, they all tally. Some suppliers may have a debit balance because we overpaid them. Most of them will have a credit. Nonetheless, debit net credit net 190 on individual customers should be the same as accounts payable control account balance. It means kulumi of India. And second comparison should be that when we purchase goods, our inventory records update to 175,000, for example. If this is the inventory figure as per the purchase order, our inventory record should also show the same amount, indicating that all okay. So this is how we reconcile different aspects. Now the next part involves the payment to supplier. Now it's the time to pay. The parties involved, authorization. The vendor now will authorize the issuance of invoice for the goods we bought. Purchasing department, it will authorize the payment voucher that now it's not purchasing department. Purchasing department is will receive the vendor invoice and it will receive the remittance advice. It will request the payment to be made to accounts payable. Custody, cash is held by the treasury, cash disbursements. Record keeping, accounts payable separate for the supplier and general ledger for the accounts payable control account. Let us see in detail. That should make sense. The cash disbursement cycle means now we have to pay to the suppliers from whom we have bought. It starts from the vendor. Vendor that has sent us goods, now he will request for the payment by sending us the vendor invoice, and he will send the remittance advice requesting the payment. This vendor invoice is received by the purchasing department. Purchasing department will compare the purchase order with the vendor invoice. It finds okay. It will send the vendor invoice to the accounts payable. Accounts payable, remember, has to make comparison. Payable department will compare the purchase requisition with purchase order, and then it will compare with the good receiving note, and finally it will make the comparison with the invoice. This is important. What was requested was ordered, was received, and now the invoice shows the same amount and quantities. Kullu miya fi miya. Now the payment voucher is authorized and requested to the cash disbursement, treasury. Cash disbursement, when they receive the approved vendor invoice, they will check all okay and they will stamp the invoice paid. Or in many organizations, you will see the invoices are crossed. If they see the invoice, the good receiving note and other documents, they will put a line on it, crossing. That means these invoices will not be resubmitted for payment. This is an important control. Either stamp each paper with the stamp paid or simply cross each paper with the lines indicating that these documents cannot be resubmitted now. Okay, so this approved vendor invoice with the payment voucher means now the check is to be raised for the supplier. This check is handed over to the purchasing department, and purchasing department will then send the check back together with the remittance advice that this check is for this invoice. The next part would be now for reconciliation. Total disbursement made during the period we made to the supplier was for, let's say, 100 and all the assumed number, $165,000 for the month or for the week. This $165,000 payment made to our suppliers should tally with the accounts payable control account showing the same amount in total paid to the supplier. Right? This is the payment made to supplier. They should tally. And at the same time, our accounts payable control account here should show the same closing balance of a supplier as the accounts payable individual sums. So this is the comparison with the accounts payable control account and the sum of the supplier's account, and this shows the balance paid to the accounts payable control account. This reconciliation means that all things are in the right order. Okay, next part now is the payroll. Payroll means the payment to the employees for the work they have performed. So again, authorization, custody and record keeping has been segregated. Authorization, human resource department, they will authorize the list approval for the employees' rates and deductions, what will be paid to each employee. They will generate this document, list of employees with the approved rates and certain deductions for taxes and etc. Production department, it is responsible for issuing employees cards, how many hours each employee worked. Custody, cash is held by the cash disbursement and cash is held by the bank. Record keeping, timekeeping keeps the record how many hours each worker worked. Cost accounting, the records for the direct labor cost to be added to the cost of production. Payroll, salaries payable to the employees. Accounts payable, they will generate the payment voucher, and general ledger, that with the record keeping with the general ledger. Let us see how it works. It starts from the human resource department. They will raise a list of employees with the approved rates and deductions. This will be delivered to the payroll department. Payroll department, based upon the rates, deduction, number of employees received from HR department, will start preparing payroll. they need to see, we have different workers, how many hours each worker worked. For this, production department will, I'm sure you know that the production department keeps the records of how many hours each worker worked, right? So these employees clock card, how many hours each department worked. This detail is kept by the timekeeping. Timekeeping department will deliver the details of how many hours each worker worked. Now the payroll department has two informations: who are the authorized employees and their pays, and how many hours each worker worked. They will do the calculations, number of workers, how many hours they worked, and what is the rate approved by the HR department. Based on this, they will generate the payroll register, how much each employee should be paid. Okay. This payroll register shows you individual workers and the pay they have to be, the amount they have to be paid. It will be having multiple copies, 3 copies. One goes to the accounts payable, one to the general ledger, and one to the cash disbursement. Now the accounts payable, when they receive the payroll register, they will raise the payment voucher directly to the cash disbursement. Cash disbursements, when they receive the payroll register and payment voucher, they will start making disbursements. Some employees will require the payment of manual check. These manual checks prepared by the treasurer are distributed by the treasurer himself. Now this is a very important point. These manual checks should not be given to the production manager. He will put the check in his pocket. Or maybe he will have some fake employees and put those fake employees' check in his pocket. These manual checks must be kept by the treasurer. Treasurer himself should go and give each check to the employees himself, A, B, C. Unclaimed checks, because employees were absent, he will bring them back. When those employees come, they will request, only treasurer will give them the check. Checks should not be given to the managers of the departments. Check must be distributed by the treasurer himself. Unclaimed checks must be put in his pocket, treasurer himself. He should keep it with them. He is responsible for custody of checks. Okay, now what happens then? Some employees get checks, treasurer should distribute the checks, and some employees would require the electronic fund transfer, right? Some in the US, within the US state, or through EFTs, and electronic fund transfer, using the electronic funds mechanism, we transfer the money directly to the bank account, right? And for this, bank needs to be paid. So we transfer a certain amount of fund, like for example, we have the payroll of $193,000 for this month. We transfer $193,000 to the bank account, the salary account, and bank, using this amount, will transfer funds to the accounts we'll give them through electronic fund transfer, right? Now there are reconciliations to be made, but before that, we need to see the sum part at the top of the left screen. Now, each worker worked certain hours on certain jobs. So we will keep all the records of the jobs and the time spent on each job. Using this employees' clock cards and the job time tickets, we will be able to allocate the cost of the direct labor on individual jobs. Maybe we are in process costing or job costing or activity-based costing. So this labor cost now should be transferred to the cost of production. How it is done, that is an area of section D, cost management. Now there are certain reconciliations to be made. We will reconcile our payroll to the total payroll expending. Total amount of the payroll to the sum of individual payments to individual employees must tally. The general ledger payroll register should also tally with the payroll records. So these final reconciliation between accounts payable file and the general ledger, and then the general ledger with the payroll records, they should indicate that all the employees have been paid the right amount and all have been accounted for, and there is nothing unexplained. Now let us do a few questions to understand our concepts. To what extent have we understood these control cycles? Question 1 says, proper segregation of duties reduces the opportunity for a person to be in position to both. Remember, we created a situation, circumstances where custody, authorization, record keeping and reconciliation, they are separated. A single person cannot commit a fraud and hide it, because if he commits a fraud, someone will catch it. If he tries to hide a fraud, someone will catch it. But if custody, authorization, record keeping and reconciliation, it is given to a same person, single person, he may commit a fraud and hide it because he is doing everything himself. So if we have a good system of internal control, if we good segregation of duties, a person both in a position to, let us see each item one by one, generalize the entries and prepare financial statements. These two things can be done by a same person. There is nothing wrong with it because both relate to record keeping. Record cash receipts and cash disbursement. This is the regular job of the treasury. There is nothing wrong with it. What about C? Establish internal controls and authorize transactions. This is the job of the senior management. They are the one who establish internal controls and they are authorized. There is no conflict between these two. Where is the conflict? This. A person should not be able to commit a fraud. Perpetrate a fraud means to commit a fraud. And he should not be able to hide it. If a person can commit a fraud and hide it, it means there is a serious problem with your segregation of duties. Like single person is recording, he has the custody, he has the authorization, he has the reconciliation. If he is doing all himself alone, it means he can commit a fraud and hide it. So this should not happen, and this is only possible when we segregate these four roles. Record keeping, custody, authorization, reconciliation must be done by separate individuals. So that means our answer is D. A person should not be able to commit a fraud and hide it. Let's see the next question. Okay, it says a proper segregation of duties requires that an individual, proper segregation of duties. We have just seen the word car. Means custody, authorization, record keeping and reconciliation must be separated. It says a person authorizing also record? No, never. Authorization and record keeping must be segregated. Authorizing the transaction and maintain custody? No, this is not right. Authorization and custody should not be the same. Then what? Maintaining the custody of the asset and entitled to access the records? Wrong. Custody and records must not be with the same person. Custody and record must not be the same person. Agree. Then what? Look at the last option. It is perfect. A person who is recording the transaction, he should not, this is the key, he should not be able to compare the accounting records of the assets with the asset itself. Makes perfect sense. A person who is responsible for recording the transaction, he should not be able to compare, he should not be able to reconcile, because record keeping and reconciliation, they must be segregated. So that makes D to be the correct option. Okay, next. Before we do this question, we need to create a little story so we know what we're doing. We have different branches across Saudi Arabia. We have in Dammam, we have in Riyadh, we have in Yambo, we have in Jeddah, maybe we have it in Medina, for example. And our head office is in Makkah, for example. Now our inventory is kept at different locations in Dammam, Riyadh, Makkah, Jeddah and Yambo. We have 3 individuals responsible for physical stock taking. And every week we give them air tickets to visit Yambo. Next 2 days they visit by air to Jeddah, to Medina, to Riyadh and to Dammam. Air tickets. And it cost us, let's say, 7,000 Saudi Arabian riyals every week visiting these 5 places. This is the cost of the control. 7,000 riyal every week makes $28,000 riyal per month, and it's a lot of money on a yearly basis. So the cost is too high. Is there enough benefit for it? Let us see. This is the question. How many times should we visit these branches? How many times should we count our inventory? There must be something we should know. The frequency of comparison of recorded accountability with asset, mean how many times should we check the asset, weekly, monthly, yearly. This is called frequency. How many times? How many times should we do? The frequency of comparisons of recorded accountability with the asset for the purpose of safeguarding asset should be determined by. Now we want to establish how many times should we visit these places in a certain period. It is dependent upon what? Let us see these one by one. It is dependent upon what? It says the amount of the asset independent of the cost of comparison. Cost of comparison doesn't matter. Why it doesn't matter? 7,000 Riyal is a big amount. On a monthly basis, it's 28,000. On a yearly basis, it's quite a lot of money. More than 300,000 Riyal. It's a big amount of money. So he says just consider on the asset, forget about the cost of comparison. We learned that the cost of comparison, cost of control should not be more than the benefit. This is a wrong statement. What about C? The cost of comparison should be considered, and whether the possibility, this meaning the word susceptibility, it means possibility. The cost of comparison and whether the possibility to loss results from errors or fraud. It doesn't matter whether it is error or fraud. If there is a possible loss, we should compare the possible loss and the cost of comparison, not just it's because of error or fraud. Both are equally harmful for the organization. What about the D option? The auditor in consultation with the client management. Consultation is fine, but sometimes auditor will have to see himself without asking the management, right? So auditor may not consult with the management. Auditor can decide to go himself for the internal auditor, can decide to go himself without the consultation of management. So this is not always true. Auditor makes his own decisions. So then what is the right option? How many times should we compare? Depends upon the nature of the asset, amount of the asset, and the cost of comparison. Excellent. This is the excellent combination. We should know what is the asset type. It is highly desirable, maybe gold or diamond. People like to steal it. Amount of the asset and the cost of making comparison. These three things must be considered, and then you should decide how many times you should conduct the stock taking. This is the perfect option. So this is how you should analyze each option in detail, and then you go for the final pick. Next. It says, which of the following questions would be inappropriate in the internal control questionnaire concerning purchase transaction? Let me tell you first what about internal control questionnaire. It is normally done in internal auditing, but let me explain. Internal auditor wants to understand how things actually work. So for that, internal auditors draws a questionnaire, and then he gives the questionnaires to the different departments for filling. An internal auditor wants to understand something about purchase transaction. He says which of these is inappropriate questions to add or inappropriate question to ask relating to purchase transaction. Let us see. The auditor can ask, are an approved purchase requisition and signed purchase orders required for each purchase? This is a very valid question to ask. Auditor can ask that, do we have the approved purchase requisition and the approved purchase order? Then the purchase is made. This is a valid question to ask, and they must answer. The management must answer this question. Are pre-numbered purchase orders and pre-numbered receiving reports used for the counter and accounted for? Are there pre-numbered orders and pre-numbered receiving reports? This is a very valid question to ask. Are all goods received in a centralized receiving department and counted, inspected, compared with the purchase order? This is a very valid question to ask. Who receives, inspects, compare the purchase order? This is a valid question. But look at the last option. This is not right. Are all intact cash receipts deposited daily in the bank? The cash receipts relates to sales receivable cycle. But we are talking about the purchase transaction. Purchase transaction does not involve cash receipt. Purchase transaction involves goods, not cash receipt. So this is a very wrong question to ask. A, B, C are the good questions to ask, but D is not the right question to ask. Next. When considering internal controls over securities, the auditor is especially concerned about internal controls over securities. Securities means maybe you have some share certificates, maybe you have some bonds, some T-bills, some important documents, investment documents. The question says, when considering internal control over securities, the auditor is especially, let's say not auditor, internal auditing is not a part of syllabus. We are trying to understand what could go wrong when there are certain shares, bonds and T-bills, some securities. So our main concern, what could be the main concern? We saw that authorization, record keeping, reconciliation and custody must be given to separate individuals. Let us see in the reverse order. Approval of temporary stock investment purchases by the corporate treasurer or the company president. You may have surplus cash, and that surplus cash can be used to purchase investments, and it is done by the corporate treasurer and company president. This is perfectly fine, 100% okay. There is no problem with it. There is no concern, no problem. Maafi mushkil. Preparation of accrual adjustments by the corporate controller. Accrual adjustments are made by the corporate controller because he is the head of accounting department. It is perfectly okay, 100%, because he is responsible for record keeping. He is responsible for record keeping. Here there is an authorization, record keeping, perfectly fine. Access to stock certificates by the corporate treasurer. Corporate treasurer has the responsibility of authorization. There is a question that can he access the stock certificate? He is the one who makes decision about the investments, and he is responsible for the investments. He has no access to records. So even if he has the access, he cannot manipulate. If he tries to change anything, there is someone who can catch him. So there is nothing wrong with it. The problem is the corporate controller, he has the responsibility for record keeping of the stock certificates, and he also has the custody of the stocks. This is a very serious risk. Why? Because he can remove the item from his records and he can simply take the custody and sell it in the market. From removal of records, okay, custody. So he can simply sell certain investments and we will never know, because records are under his control, custody is under his control. So he can sell some investments, remove it from the records, and no one will ever catch him. This should not happen. This is a very serious problem. We should not let this happen. The person responsible for record keeping should not have access to the physical assets. Okay, let's see the next question. Which of the following is not an internal control objective of the revenue cycle? Remember, the revenue cycle involves sale to the customer, resulting in an account receivable, and then collection of cash from the customer. So which of these is not the objective of internal control? Let's see. Revenue cycle transactions are properly executed. This is the objective, that the revenue transactions are okay. Appropriate goods are ordered so that the sale can be made. We didn't see anything like that. Appropriate goods are bought and then they are sold. This is not the objective of revenue cycle. The revenue cycle only involves sale to the customer and collection of cash. Whether the goods were right or not, this is the part of purchase cycle. This is not the part of the revenue cycle. Wrong. Transactions relating to revenue are properly accounted for. This is perfectly okay. Custody over the assets, the goods we bought, resulting from the revenue cycle is properly maintained. This is perfectly okay. A, C and D are perfectly okay, but B is not appropriate. This is not right, because this doesn't relate to the revenue cycle. Next question says, in retail cash environment, like maybe in many stores across Saudi Arabia, you might have seen many giant stores like Tamimi is a very big chain of stores in Saudi Arabia, Makhazin al-Kubra, giant stores, and many others. What you see there is that the people at the cash register, they have a computer screen in front of them, right? That means they have the access to the records, because computer screen has the records of inventory. And at the same time, they have the custody to cash. So this appears to be something not right, because the person at the checkout counter, he has access to cash and access to the records of inventory. They are incompatible. So yes, there is a problem. But unfortunately, this is an essential. Record keeping and records must be maintained by the same person, because he is updating the inventory record at the same time he is taking cash. This is a problem. Then what are the controls, the compensating controls? Now let me tell you what are the compensating controls. There is a camera on top of this person watching over what he is doing. He is not putting cash in his pocket. And this is the first control. Second control is that for every person or the checkout counter on the cash register has been given a limit of 10,000 Saudi Arabian Riyal. He can make a sale up to 10,000. Beyond 10,000, the system will lock. The supervisor will come. Supervisor will take the cash from him, 10,000 Riyal, give him the receipt, and then the cash register starts working again. So a camera is watching over him, and he has been set a certain limit. Beyond that limit, he cannot sell. The system will lock. So these are some compensating controls. So the question says here, in a retail cash sales environment, which of the following control is often absent? What is absent? Competent personnel? No. The person who is working is competent. No problem with it. There is supervision. Asset access limited to authorized personnel. The problem is that segregation of duty is compromised, because the person who is managing the cash, he is the same person who has the access to inventory records. So the segregation function is missing, is absent, and we have some compensating control to manage this risk, because there is a camera over his or her head, and we also have a limit of cash he can do the transaction record keeping for. So this is what is missing, and we have some compensating control to remedy the problem. Next question. It said the procedure that would best discourage resubmission of the vendor invoices after they have been paid. There is a risk, I'm sure you would have seen in your accounting department, that maybe your sales team, they spent 1500 Riyal on entertainment, staff entertainment, when they visited a facility. They gave this invoice, this fatura, to the cashier. Cashier gave him 1500 Riyal. This invoice goes to the accounting records. This invoice somehow, maybe by collusion, this invoice comes back again to the persons, and this can be resubmitted. Same invoice can be resubmitted 2 or 3 times, and you can take this 1500 amount multiple times. This is a risk. That the same invoice, because there are so many documents, we cannot always remember that the document is the same or the new one or the old one. So what should happen? When this invoice is paid, it should be crossed. Either there should be a stamp paid or pasted on it with the title paid, or easiest and cheaper way, what we used to do in Saudi Arabia, we simply used to cross it. Halas, this is crossed means paid. They cannot be resubmitted. Sometimes it's called defacing. It cannot be resubmitted. Most of the students, they get confused that this cancellation is done by the accounting department or this cancellation is done by the treasury. This is interesting. And most of the students, they go for B, which is wrong. Now let's come back to the question. It's a very good question. The procedure that would best discourage the resubmission of the vendor invoices or any invoice, food invoice, or maybe you bought some consumable invoices after they have been paid. We want to discourage that the invoices once paid, they should not be resubmitted. What should be done? Let us see the options. A requirement for double endorsement of checks. What is double endorsement? This is the check drawn in your favor. The banker will ask you to sign twice at the back of the check. So this double signature, double signing, this is called double endorsement. right? This is not the problem here in our question. The mailing of payment directly to pay's personal account, this is good, but we are not concerned about the payment to employee's salary. Issue is that the invoices should not be resubmitted. Now there are two options, and most of the students are confused, and mostly they go for B, which is wrong. The cancellation of vouchers by accounting personnel, no, this should not be, because accounting personnel, they only have the access to record keeping. They don't pay. Who pay them? The treasury personnel. Treasury pays them. So this defacing should be done by the treasury department. They should cross the documents and maybe put the sign paid or just write this way. So cancellation of vouchers are done by the treasury personnel, those who manage cash, those who pay, not accounting. This would be wrong. Many students click this option B, which is technically not right, because the payment is made by the treasury, so they should cross. Okay, next question. It says, organizational independence in the processing of payroll is achieved by the functional separation that are built into the system. Custody, authorization, record keeping, reconciliation must be segregated. This is what we know. Okay. So organizational independence in the process of payroll is achieved by functional separation that are built into the system. Which of the following functional separation is not required? Which of the following is not required? Let us see one by one. Timekeeping and payroll must be separated. Yes, they are. Let me show you. This is important. So here we go. This is timekeeping, responsible for maintaining the time spent by each employee on the jobs, and this is payroll. They are separate. If they are one, now what is the risk if they are one? If timekeeping and payroll, if they are one, the risk is, if I am the payroll supervisor, I have a friend, nice friend Asif. What I will do, I will put his hours as 50 hours of the week. Maybe he worked only for 20 hours. I will put 50 hours because I am the one keeping the time and I am one paying the payroll. I can change his records. I can change his timing so as he gets paid more. So timekeeping and payroll, they must be segregated. Right? There is a risk that the hours worked can be changed. So we should not let that happen. So this is right. They must be segregated. This is true. There is segregation required and the right segregation is there. Separation of personnel function and payroll preparation. Again, this is right. Payroll and HR must be separate. Why? Because if HR and payroll are the same, there is a risk that HR might add some fake employees A, B and C, and they are themselves managing payroll, so they will make the check of ABC, and maybe ABC are my brothers and sisters. So HR and payroll, they must be segregated because there is a risk that some fake employees can be paid by the payroll and they are also managing HR and payroll. This should not happen. So there is a separation required in it. What about C? The separation of payroll and paycheck distribution. This is also important because payroll, if they are responsible for distribution of checks, they might make some fake entries of X, Y and Z, and they have the checks of X, Y and Z. Since there are no X, Y and Z in the company, they will take this X, Y and Z in their pocket and go home. Payroll should not distribute check. Who should distribute check? Treasury. So this is right. There must be separation in C also. So A, B, C require separation. What does not require segregation is D. Preparation of payroll records and maintenance of year-end records. Perfectly fine. 100% Mia fi Mia. Why? Because both are record keeping. Both are record keeping and they are unrelated. Payroll preparation and the year-end accounting records, it is perfectly fine. Nothing wrong with it. They can be done by the same person. Okay, next. This is again a good question. Good question. It says, an employee should not be able to visit the corporate safe deposit box containing investment securities without being accompanied by another corporate employee. Maybe you have a safe deposit at a bank. A single person should not be allowed to go and access that safe deposit box that contains our investments. The risk is that a single person can take those investments and maybe sell it or maybe use it as a collateral to take loan. So an employee should not be able to visit the corporate safe deposit box containing investment securities without being accompanied by another corporate employee. Two people should go. What would be the possible consequence of an employee being able to visit the safe deposit box unaccompanied? What is the risk if a single person goes to the bank and access the locker? What is the risk? The risk could be the employee could pledge corporate investments as security for the short-term bank loan. Yes, this is what he can do. He can take out those investments and use it as a collateral to take a personal loan. This way, the investments stay with the bank, still with the bank. But the problem is not those investments have now been used as a collateral for a personal loan. This is the problem. This should not happen. If two people go to the bank deposit, then such thing cannot happen. Let's see. What about B? The employee could steal securities and the theft would never be discovered. Wrong. If the employee steals the security during reconciliation, the issue would come out. In A, it will not come out because the record keeping and the custody will reconcile because the investment is still with the bank. Bank can verify that. But in case of B, if employee steals the securities, it will be caught. It will be identified by the system. What about C? It would be impossible to obtain a fidelity bond on the employee. What is fidelity bond? Fidelity bond is normally a written guarantee by the employee that he will not commit anything wrong. So it would be impossible to obtain a fidelity bond on the employee. Getting such a bond is a separate thing. Maybe a person has given, I am a very nice person and I will not do anything wrong. I am a quiet person, but still he can do something wrong, right? So this fidelity bond is only on the character. Whether he does anything or does not do anything, it depends upon the system of internal control. Our control should be strong. Even getting written bonds from the employee will not resolve the problem. We should have a good system of internal control. This will not resolve the problem. Maybe he have a good character, but our system of internal control should be good. What about D? There would be no record when the company personnel visited the safe deposit. Wrong. Whenever any employee visits the bank, bank maintains a logbook. Bank maintains who visited, at what time, how many minutes or hours did he stay, and at what time did he leave. All is logged into a logbook. So this is wrong. It is always available. So we know for sure that the A option is the most appropriate option. Let's see the next one. Next question says, which control is not appropriate for property, plant and equipment? Not appropriate. Let us see these one by one in the reverse order. D says written policies for capitalization and expenditure and review of application of depreciation methods. We should have a written policy. What cost do we capitalize in the asset? Which expenditure is capitalized? And which depreciation method should be used? This is a good control. It is perfectly fine. Appropriate. Detailed property records and physical controls over assets. What are the assets we have and who has the control over them? This is a perfect control. Good control. Proper authority for acquisition and retirement of assets. Whenever we acquire asset, it must be properly authorized. Whenever we retire an asset, there should be a proper authority for it. This is a good control. But this is ridiculous. Any asset that is fully depreciated, like maybe in Saudi Arabia, I've seen many cars which are depreciated after 5 years to net book value of 1 Riyal only. So does it mean now it is fully depreciated, we should sell? No, there is no such thing. If this is the policy, every asset that is fully depreciated, people will sell it for a lot of money and put the money in their pocket. This is a very wrong policy. Disposal of fully depreciated assets. I have seen many assets for over 15 years, fully depreciated, but they are still used by the business. No problem with it. So this is a very wrong policy that the asset that is fully disposed should be sold. This is wrong. Not a correct policy, not the right thing. This is a very good question. It says internal control should follow certain basic principles to achieve its objective. One of these principles is the segregation function, that is, custody, authorization, and record keeping and reconciliation should be done by separate individuals. Which of the following example does not violate the principle? This is important. The key to this question here is which of the following does not violate the principle of segregation function. Let us move in the reverse order so we know we are getting the right answer. The department time clerk is given the authority to the department clerk is given the undistributed payroll checks to mail the absent employees. Never. Undistributed payroll checks should be with the treasurer, not with the department time clerk or the manager. This is a very wrong activity, wrong approach. We need to find which is okay, which does not violate segregation function. The sale manager has the responsibility to approve credit and authority to write off account. This is very, very dangerous. Very dangerous. Sale manager should not approve credit. Sale manager should not approve bad debts. The risk is sale manager can sell goods to his friend X because he approves the credit, and then after some time say, oh, X is gone. He's barra, alatul, gone. He can write. This is not right. Sale manager should not approve credit. He should not write off account. This is not his job. He should only sell. To whom should we sell? He doesn't tell. Who do we write off? He doesn't tell. This is serious. So this means we don't have C and D. What about B? B is again very wrong. Our warehouse clerk, who has the custodial responsibility, who maintains the custody of the asset over the inventory in the warehouse, may authorize disposal of damaged goods. He only has the custody. He should not have authority to sell. This is wrong, because if it's so, he will say everything is damaged. Okay, sell this, sell this, sell this, sell this. Why? He is not authorized to sell the inventory that he thinks is damaged. Wrong. This is not his authority. Maybe who will do it? Maybe general manager, maybe some managing director, someone responsible. So this is not right. This is not right. This is not right. Then A has to be right. Let's see. The treasurer who manages checks, he has the authority to sign check, fine, but he gives the signature block to the assistant treasurer to run the check signing machine. Perfectly fine. Treasurer can delegate his job to his worker. Delegation is perfectly fine. If I am the accounts manager and if I'm responsible of certain work on letter of credit, I can delegate my work to my assistant. Delegation is perfectly fine. There is nothing wrong with delegation. So this is basically delegation. This is not the violation of principle of segregation function, right? So that makes A to be the correct option. So the important point in these questions is that you should not rush to the correct option. You should read carefully. Take time, doesn't matter, because you are preparing now. On the exam you should rush, but right now you are learning. So when you are learning, take your time. Maybe take 5 minutes on a single question, but you need to make sure that you understand things well. If internal control is well designed, two tasks that should be performed by different persons. Let's see. Let's see which two tasks should be performed by different persons. Let us see each option one by one. Approval of bad debt and reconciliation of account payable subsidiary ledger. No problem, they are unrelated because bad debt relates to account receivable and payable relates to account payable. Even a single person does it. They are unrelated, no problem with it. This is perfectly fine, 100% okay. Because they are two unrelated jobs. If one person is doing, no problem. B. Distribution of payroll checks and approval of sales returns. They should be done by separate people, but even a single person does it, no problem. Sales return and payroll check, they are so different. A person doing both things, no risk, no problem at all, 100% okay. Posting amounts from both cash receipts journal and cash payment journal. This is record keeping. Cash in and out, a single person does it. It is 100% okay, no problem with it. The problem with it is D. This is a risk. Recording cash receipts, you are the one who is responsible for recording. and you are the one who is responsible for reconciliation. No, this is not good. This is not quiz. Recording and reconciliation, they must be with the separate people, not same person, not right. The risk is, you know what the risk is? He receives cash, he puts 15,000 Riyal in his pocket, finish, and then he says reconciliation is okay, all okay. He hides the cash and reconciles, both sides look good, everybody is happy, but there is a risk that we may lose money this way. So this is something that is done by two separate people. BRS and cash receipts should be done by two separate individuals. Okay, what about the next one? Which of the following situation represents internal control weakness? Where do we find internal control weakness? In the payrolls department. Let's see. Payroll personnel are rotated in their duties. There is a rotation in duties. Perfect. This is good. This is good. What about B? Paychecks are distributed by employees' immediate supervisor. No. This is not good. If payroll checks are distributed by the employee supervisor, he may put some check in his pocket and say, okay, now this is your, maybe your party amount. We will spend this money on party because you are new employee. Your first salary will be spent on partying, or maybe for a treat or for some good food. This is not good. The paycheck distribution must be done by the treasury. The treasurer should do it, not the payroll. This is wrong. This is wrong. What about C? Payroll and are reconciled with quarterly tax report. This is perfectly fine. Good. The timekeeping function is separate from payroll department. This is good also. So A is good, C is good, D is good, but B is not good. Payroll check must never be given by the departmental head. Risk he might put the money in his pocket. Alright, next. Which of the following activities represents both an appropriate personnel department function and a deterrent to payroll fraud? Now there is little technicality in words. Let us try to understand what the question is saying. Which of the following is both an appropriate personnel department function and a deterrent to payroll? So where do we see both things? That means the good system of internal control and an appropriate prevention of fraud. Two things in the same option, that is the appropriate role of the HR department and the prevention of fraud. Let us see these one by one. Payroll department should distribute payroll check. No, this is not the job of the payroll department. Payroll department job is not to distribute check. The check distribution should be with the treasury. Authorization of overtime. Authorization is not the job of the payroll department. This is the job of the operating management, the management responsible for the staff member who worked overtime. Wrong. Then what is the right role of the personnel department? Authorization and addition and deletion from payroll. This is the right role. This is the perfect job that HR department should do. So the question is, this is an appropriate personnel department function, and it is also a prevention of fraud, because this will help only add those employees who are legal and legitimate employees and remove those employees that are gone from the organization. So addition and deletion of employees from the payroll, it is the job of the HR department, and it will prevent payroll fraud, because only those employees will get paid, those who are in the business, those who are working in the organization. What about D? Collection and retention of unclaimed checks. Collection and retention of unclaimed checks. This is the role of the treasury. Treasury maintains the unclaimed check. This is wrong. Not the job of the payroll, HR department. So that means the right option is this: authorization of addition and deletion from the payroll. Okay, what about this? It says, which of the following situations represents a strength of internal control for purchasing and accounts payable? So we are looking for the strength the strength of the internal control for purchasing and accounts payable. Let us see. We are looking for the strength. Pre-numbered receiving reports are issued randomly. This is a weakness. Receiving reports should not be issued randomly, rather they should be issued 1, then 2, then 3, then 4. This is wrong. What about B? Invoices are approved for payment by the purchasing department. Apparently, this appears to be the right option, but this is not. The approval of the invoices is with the accounts payable, not the purchasing department. If you give this authority to purchasing department, they will pay to his uncle, to his mother, to his brother, all the payables he will approve, the purchasing department. This is a risk. Purchasing department should not approve the payment. The accounts payable does it. Okay, what about C? This is wrong also. Unmatched receiving reports are reviewed on annual basis. La, this is wrong. You should review it on weekly basis. I would say on daily basis. Unmatched receiving reports at least weekly or at least monthly. But yearly, this is too long. It's too late. Maybe the fraud might stay undetected for a year. Should not let that happen. So A, B, C are not right. What is right? What is the strength of internal controls in accounts payable? Look at this. This is perfect. What you do, you take your purchase order. Let me write it again clearly. It's a very good question. You take your purchase order. You take your receiving report. You take your invoice and compare these three. How you compare? You ordered ABC. Yes, we ordered ABC. How many items you ordered? You ordered 100A, 90B and 80C. How many you received ABC? I received 100, I received 90B and 80C. Good. And what is the invoice? Invoice contains 100 A's, 90 B's and 80 C's. Kullu miya fi miya. Perfect. Everything is in order. And once we find all these in order, then only we book a liability. This is the right thing. It says vendor invoices are matched against the purchase orders and receiving reports. Purchase order, receiving report and invoices, they are matched. Only then we'll record a liability by debiting the goods or the purchases, credit accounts payable. And that makes perfect sense. This is the right option. Next. The utility company, utility means like STC, like Department of Koharbain in Saudi Arabia, electricity department, water department, telephone department. These are called utility companies. A utility company with a large investment in repair vehicles, a company that distributes electricity, it has many vehicles which we use for repairing. It would most likely implement which internal control to reduce the risk of vehicle theft or loss. So maybe we have 100 vehicles and we want to reduce the risk of theft and loss. How can we do that? How can we do that? Risk of vehicle theft or loss. Let's see. It's a good question. Very good question, I must say. Review the insurance coverage of adequacy. We want to avoid risk and theft. Why should we use insurance? There should be no theft in the first place. Insurance comes as a second or third protection. We should not let vehicles loss. We should not let any vehicle theft. So this is not a right approach. Insurance is good, but we should have some good control to avoid theft and loss. Systematically account for all repair works orders. Where repair work was required, A position, B position, C. This will not prevent vehicle theft or loss. This will only ensure that the repair work was done systematically. We want to protect our vehicles. That's the main issue. Physically inventory vehicles and reconcile the results with the accounting records. That is the bank, like a bank reconciliation statement. It will identify that some loss has happened, but it will not prevent. I told you a little while ago, if you give me $100, sir, $100, spend the money you want on internal control. I will spend $99 on preventive controls. These are the best controls which will prevent from any problem. Reconciliation, it will only tell this loss has happened. Right? Insurance coverage, okay, this is the non-loss, okay, go for the insurance coverage for loss recovery. We should not let problems happen in the first place. Don't let problems happen. Prevention is the best cure for any problem. I will spend $99. This is the best preventive control. I will maintain all vehicles in a secured location with guards and cameras, and these are the vehicles placed in this location. And any vehicle goes out and in, it is subject to approval by the custodian. Any release and return, it is subject to the person who is responsible for these vehicles. This is the best preventive control. Keep your vehicles in a tight, secured location with the cameras and gates. Any in and out is approved by the custodian. This is the best preventive control. And preventive control are the most effective in managing a good system of internal controls. Next. To minimize the risk that agents in the purchasing department will use their positions for personal gains, the organization should do what? We know that many people in the purchasing department, they might make connections with the vendors and they take rishwa. Agent A, B, C, D, E. So they make contacts with the vendors, with the suppliers, and this means they can then take commission. We should not let this happen. We should not allow our agents to make personal relationship with the vendors. So what we should do? Good question. To minimize the risk of agent that in the purchasing department will use their positions for personal gains, the organization should do what? Let us move in the reverse order so we get better understanding. Direct the purchasing department to maintain the records on purchase price paid, with the review of such being required at each 6 months. This will not resolve the problem. For 6 months, we have the same people sitting as purchasing agents, so they will build relationship with the vendors so they can take rishwa. We don't want that to happen. Then specify that all items purchased must pass value for unit cost reviews. That every item we buy, should have a certain cost per unit, a standard cost per unit. It will not detect that our vendors and our agents, they might have relationships and there is some money going in and out in the form of rishwa. This is not a good control. Request internal auditors to confirm selected purchases and accounts payable. Again, it will not resolve the problem because all the purchases we made and all the accounts payable, they will always tell you, because accounts purchases and accounts payable, they will reconcile. They will not reveal any fraud, any rishwa. Rishwa is not in the books of account. Rishwa is paid by the vendor, and the vendor pays in cash, and this goes directly into the pocket of A. This is something we want to avoid. That vendor does not pay rishwa to the agent, and what we can do for this, we rotate purchasing agents' assignments periodically. We keep on rotating the purchasing agents into different jobs so they do not develop relationships with the vendors so as to take some rishwa. So this is a good control. We can limit their activity. We can rotate them from one position to other so they don't make personal relationship with the vendors. Next we have, again, a good question. It says, management can best strengthen the internal control over the custody of inventory stored in an off-site warehouse. We have inventory placed in off-site, means some far place. So the best control over that off-site inventory, what we should do in such a case. Let's see. Option A, reconciliation of transfer slips from the warehouse with inventory records. You are just reconciling the records. What if the inventory is actually stolen? You are just taking the records here and records there. Do we have the actual inventory physically? This will not reveal, not a good control. Increase the insurance coverage. If any inventory is lost or by theft or anything, insurance money will pay. We don't want insurance money. We want to prevent. Remember, preventive controls are the best controls. Give me $100, I will put all the $100 on preventive controls. All $100. This is the best control. So what should we do? Regular reconciliation of physical inventories with the accounting records. You go to the warehouse, you count the goods A, B, C, D. What are the records? A, B, C, D. Okay, kulumi. That is the best control. Check your physical inventories and match it with the accounting records, and they both should be okay. This is no doubt, this is the best control. What about the options D? Regular confirmation of the amount on hand with the custodian of the warehouse. Okay, this is a silly approach. Okay, how many goods we have in our records? Our goods have a cost of $100,000. Okay, We call the warehouse, Mudir Masauda, hello Ayad, how are you doing? Okay, what is the value of inventory? Wallahi, value of inventory is $100,000. Okay, Kulu Miya Fimiya. This is wrong. You simply cannot call or confirm the amount from the warehouse manager. You need to go there and count the goods yourself. A, B, C, D, E. A, B, C, D, E. Okay, now they are telling. This is the right thing. Calling and confirming will not reveal. You should count things yourself. This is again a good question relating to payable purchase cycle. Okay, what the question is all about. The question says auditors document their understanding of internal control. Auditors, when they come, they try to understand the system of internal control by writing questions. They use the flow charts, right? System flow charts. They use the narrative description. They interview people so that they can understand the system of the client. A questionnaire consists of series of questions concerning controls that auditor consider necessary to prevent or detect errors and frauds. Auditor want to understand the system of the client so that they know what are the controls in the place, what are the problems, what are the processes where things can go wrong. The appropriate question designed to contribute to the auditor's understanding of the completeness of expenditure cycle. Auditor wants to understand the completeness of purchase payable cycle. So which question should he add? Or forget about auditor, we just want, we are accountants. We want to understand which of these relates to the purchase payable cycle, because internal auditing is not in part of our course, but we should know. Let's see. First, internal verification of quantities, prices, and mathematical accuracy of sales invoice. Sales invoice has nothing to do with the purchase payable, because purchase payable involves accounts payable. Our purchase is not sales. This is totally wrong. Okay, then what about B? Use and accountability of pre-numbered checks. Yes, checks play a part, because when we make purchase from our supplier, after 30 days we have to pay them. So yes, how do we use the checks and how the pre-numbered checks are maintained? This is something which is good, which is a part of the purchase payable cycle. But A is not. What about C? Disposition of cash receipts. Again, cash receipts relates to sales receivable cycle. Qualification of accounting personnel, whether the accountants are CPAs or CMAs or CIAs. This is again not an issue of purchase payable cycle. Purchase payable cycle relates to goods bought on credit from accounts payable, goods received in our warehouse, GRN is drawn up, and then this all. So this doesn't relate to accounting personnel. So the best option we have is the use of pre-numbered checks in case of making payment to the suppliers.